Hey, what's up my beautiful people? For all those who are new, my name is Dana and welcome to my channel. And I don't like personally when bloggers are saying a lot of blah 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 in their videos, so let's jump straight to the content. But first, subscribe and hit the bell. What if somebody offered you to invest in a company that has been around for well over a decade but hasn't had a positive cash flow for about 4 years? In fact, they actually burned more and more cash each year. With a low price of $345 per share, would you take it? Even though this should sound like a scam, that is exactly what Netflix company and their CEO Reed Hastings asks and get from investors. Well, Netflix did have positive cash flow for many years, and now they're spending the money on expanding content and also their international presence. This Excel screenshot comes directly from Netflix investors presentation. Right now, Netflix is running approximately $1.4 billion per year, making about $14 billion annually. But what really stands out are the investments in content. On a 12-month basis, their spending stands at $10.8 billion, simply meaning that 80% of all revenues turned back right into making content. Netflix made healthy profits by providing customers with a lot of B-rated movies while there was nothing to watch on television. As you can see, their revenue grew 36.2%, while their content spend grew 13.1%. Simply saying, for every $1 Netflix puts into making content, they turn out about $3 in revenue. Let's take a step back for a second and understand how Netflix treats its content expenditures. While they may take the cash hit immediately, their content is amortized. Right now, the amortization specifically accounts for 50% of revenues. So it's reasonable to assume that if Netflix slowed or stopped their content production, with all other things being equal, they would see a drop in cost of revenues and increase in earnings within few years. Now let's take a look at what will happen to Netflix company if it will continue at the same pace through 2022, with both growing in revenue and their content production, with all other things being equal. Take a look at this table. It uses the 20% of growth per year. As you can see that now you're sitting at $10 to $12 per share in earnings, considering the current stock price is multiple in 30s. That isn't a far-fetched, especially when considering that the company could grow much faster or realize the economies of scale with the content they produce. Anyone who has done some research at Netflix knows that they finance their growth with a lot of debt. Right now, the company is whopping at $8.3 billion of debt outstanding. For a company that doesn't have a positive cash flow yet, they have less than 2 years to put their act together. That's a pretty tight timeline, leaving virtually no room for error. Netflix needs to put it up or it will be shut up very quickly. Still, it is unlikely that Netflix will fail to hit their goals in the near term. The thing is that they could easily scale back on content spending to drive cash flow, but it's not likely. They would probably use every opportunity to push all their dollars into growing as fast and as large as they can. Whether this company would be able to achieve some form of economy of scale on content or finally gain some traction in the international marketplace remains to be seen, but we still need to keep an eye on this stock. That's all for today, guys. Thank you so much for watching. I hope that you liked this episode. If you did, please comment down below what you think about Netflix company and probably some suggestions and comments. I would really appreciate that. Also, visit stockmetrics.net in order to see the full analysis about Netflix company itself. Visit my, social media accounts, and I would see you next time. So, bye.